this trading week started after the close on Monday. First Republic had a 12-minute conference call. They did not take any questions. They talked about the capital flight or the deposit flight from the bank. They didn't even include the 30 billion when they were doing the math that the 11 banks had put in, I guess, in March at the throes of this sort of drawdown, right? And so, just the lack of clarity about them, the kind of news that they might need to raise capital and really get some bidders for some of these bad assets. And they're not bad assets. They're just the held to maturity. They have the losses, and they can't, until they basically shore up that, they can't raise equity, right? And so what are we waiting for here? And, we had a great conversation guy on Market Call earlier in the week, so you guys could find it, with Sean Ryan. He is the financial sector lead over there at FactSet, and he had a report out on insight.factset.com, bank crisis in remission, but not over. And I thought that was really interesting. So a lot of the questions, and Danny, you may have a take on this, is like the Fed, the Treasury, the White House, the FDIC, they're not doing anything right now. And supposedly David Faber was reporting this on CNBC on Wednesday, that they're really putting pressure on all of these other banks that put those $30 billion in deposits into First Republic for 120 days to maybe help them with some of those bad assets, buy them at a loss. Because the question is, if the bank has to go into receivership because deposits continue to leave, then all of those major banks are going to be on the hook for it, because they all pay into the FDI insurance fund, right? So it's kind of going to be an interesting scenario. And I guess the question is that if they come at really bad terms, right, for the big banks to basically sieve First Republic, and then let's see where the equity is raised. You guys, this thing's down 98% from its all-time highs. There is no equity. It's about $1 billion. So I guess the question is it systemic? If it comes at really bad terms, or it doesn't get done, or it goes into receivership, is this likely to be a dominoes effect? And then are we talking about, and this is the point that Sean Ryan was making, it's just in remission, it's not over. It seems like we're in the second or third inning of this, Danny.
So total deposits are down to 50 billion, of which 30 billion is the 11 banks that put in the amount, right? So when you think about it, it's down to pretty much, on a relative basis, what they had at the peak, it's down to nothing. And they're trying to strike a deal right now, to your point, where they offload these securities at, quote, a premium, and in exchange, give out pieces of the company, right? Or raise money and under good terms to these other banks that are out there. What I believe is going to happen is it's a JPMorgan Bear Stearns moment, in my opinion. And what the Fed can't do and Treasury can't do is punish these 11 banks who truly, did their part, obviously, to come. And we don't know the ins and outs of what hand forced who, but look at this part, Dan. This is an important takeaway. They have completely retrenched First Republic from the jumbo mortgage market, right? And they have a huge amount of high net worth private clients that are out there. Look at mortgage rates. There's less competition, obviously, when an FRC is not out there originating loans. Who's the perfect fit for this? In my opinion, it is JPMorgan, right, at a certain price. And so make no mistake. I mean, Jamie Dimon is a shrewd, smart banker. And so there are things going on behind the scenes for sure, Dan. It's a game of chicken. But the Fed cannot, in my opinion, let this thing go, or the FDIC cannot let this thing go, because then you're dealing with a situation, Dan, that you just made, where there is a contagion, because you'll lose the faith of the large banks. And as much as people are scared about the big banks getting bigger, it's a lesser of all the evils right now to kind of bring safety into the market.
For context, not that it particularly matters today, but so First Republic is having a decent day today, which is almost comical to say it's up maybe 11 or 12%. It's trading, I still think, south of $7. Again, for context, this stock was north of $215 in the fall, actually November of 2021, if you want to get down to brass tacks, which is not coincidental. As recently as a month and a half or 2 months ago, this was a $125 stock. Again, not particularly important. So I mention it because here we are around $6.50 or so, number one. So we've been saying for a while that we're going to see a take under at some point. A lot of people thought that might come in the form of Credit Suisse and UBS. Maybe. I thought there was more to come. Other people did as well. With that said, what's sort of the systemic risk, or more importantly, what are the knock-on effects of this? Again, just my opinion, but when you think about the U.S. economy, again, 75% of the economy is driven by people buying shit, whatever that is. I think small employers, small businesses, mid-sized businesses employ north of 70% of the people in this country. First Republic and other regional banks, and Danny can probably speak far more intelligently than I think there are over 4,000 banks in this country, most of them under the umbrella of a publicly traded company. Um, they're in a bit of a pickle here because whether they realize it or not, I mean, there's going to be a flight to the perceived safety of some of these obviously systemically important banks. And we're seeing it. Just read their earnings reports. You're seeing the inflows that these big banks are seeing. So, what does that mean? Well, if people no longer, small businesses no longer have the same access to capital, or if it's going to be more expensive, or some amalgamation of the two, that's not particularly good. That's going to really hamstring small business. If small business is hamstrung in this country, the consumer is as well. And that's what's happening. Credit conditionings are tightening. Small banks are, I don't want to say in trouble because that sounds a bit hyperbolic, but clearly marginalized. And that's all at the foot of what we've seen over the last couple of weeks. So it's not necessarily what's going to happen to First Republic as much as it is what's going to change consumer behavior and what's going to happen. And I think that's the next couple of chapters in this story.
You bring up a great point in terms of what are these other banks going to do? And here's the game of chicken. If you're going to announce an offering of some kind, you better have everything buttoned up. If you're a Western Alliance, if you're a PacWest or one of these regional banks, right? Because if the economy does turn, and we just had a 1.1% GDP number missed from 1.9, but that's neither here nor there. And by the way, I will note that the PCE within that number was much higher than expected, which is a problem for the Fed. But if you're one of these banks and you're on the board of a bank, what do? It's a game of chicken. All right, guys, we need to raise $3 billion, right? We want to sell these securities. If you start to do that and you haven't completely buttoned it up, your stock's going to go down 80%, 70% because you're showing weakness. So the backdrop guy of credit getting worse on the margin, not a catastrophe, getting worse, is only going to make it harder. Because if these companies have to take larger loan loss reserves, just normal cycle loan loss reserves, which are going to occur over the course of time, it's going to get harder. And that goes back to the commercial real estate exposure. We see articles every single day now on office. We have vacancies of 85% in some towers right now in San Francisco. It's written about. So that's kind of where we are. And I think that's what's really lost. It's lost on the Schwab argument. It's lost of, oh, the Schwab argument. Okay, the bank, they have 20-something billion in losses potentially to mark to market. But the backdrop for Schwab would be, what if the market goes down 20, 25% from here? What if because that will force more questions and more things. And thankfully, a lot of these banks haven't had to, quote, deal with this yet, but I think that's coming soon.
You know what's fascinating, Danny? So you just mentioned that this is kind of a Bear Stearns JPMorgan moment. And just to go back to March 15th of 2008, JPMorgan paid $2 on that Monday morning, right, for Bear Stearns. And that was kind of the backstop. And I think a lot of folks, at least investors, strategists, easily what the central bankers and the feds were saying is like, that's it. We backstopped it. You know what I mean? There's not systemic risk here. And your point is, I don't think you're suggesting that this is going to be a redo of 2008, because if you think of just kind of the banks that we're talking about, they're generally much smaller here. But what's important to remember from the low, and it's just remarkable that they happen to be almost to the day, because it was March 15 when SVB, right, got basically taken under here and backstopped by the feds, at least their deposits. So March of 2023, Silicon Valley, March 15 of 2008, Bear Stearns. And I'll just say this, the S&P 500 from 2008, March 15th to mid-May, it rallied 15%. Okay. Like it rallied 15% with market participants thinking that that was contained. Okay. The BKX rallied 20% more than the S&P 500 did. And we know what happened after that. So when I look at what's gone on here, the S&P almost touched 3,800. Here we are at 4130 right now, okay? And we still actually have not broken out of this range. So I guess what I'm just kind of putting a button on is like, it really feels very, very similar. There's definitely going to be more shoes to drop. And your point about Jamie Dimon waiting in the wings, listen, he could pay $3 billion in equity value and take all these assets, take all these deposits. They would see deposits rush into First Republic. They'd see the activity that they would able to do with these customers on the loans, right, increase dramatically. But he's waiting for something. And the equity is basically zero right now.
This is nothing like the situation, obviously, with Bear Stearns and JP Morgan, other than it could be the same suitor. Here's the irony. We talked about this before. these are securities that are effectively guaranteed by the government, right? I mean, here we are, mortgage-backed securities, treasuries, right? We know they're money good. And so the other ones weren't, because it was still an unknown at the time. What are these triple B? What you tell me the AAA mortgages aren't good? There was so much leverage in the system. That's the irony, I think, that's kind of lost on all this, and it's a mark-to-market moment. And I'm going to say one thing on, as long as we're sticking kind of Washington and so forth. So as of May 1st, the FHFA, right, which basically controls Fannie and Freddie, which again got bailed out back in that time period. Let's not, you know, forget that, right? So they are basically changing these LLPA fees, right? These loan level pricing adjustment fees. That, so for a conforming loan, which can be up to 726,000 or whatever, right? A wrapped loan by the government, right? That they're going to charge higher FICO scores and larger down payment people more, at the expense of allowing, which I'm all about, everyone should own a home, lower income, worse credit, right? So it's not a major thing, but to me, from a moral hazard perspective, again, yes, housing market is certainly peaked. Forget about the home building stocks for a second. And we're now basically incenting people that otherwise may not qualify and certainly may not be able to afford a mortgage to get into the housing market. Now, I'm all for that. I think people should have a right to own, but really at the expense of the higher credit. So you're now incented, at least in the mortgage world. And again, let's put this in perspective. On a $400,000 loan for a high quality consumer, it's $40 more per month. But the point is this, like, I have a real philosophical problem with doing, I would take it from somewhere else to incent people. Anyway, I had to get that off my chest because it happened last week and we did get a chance to talk about it on the show, but that's going into effect May 1st. And again, it's another agency in the US. And I just find it ironic that this is the same agency that bailed out Fannie and Freddie and saw firsthand what can happen when credit terms are too loose for borrowers that shouldn't be able to get access.